Hello and welcome to the presentation. Today we're going to be talking about IRAs that make money by being a lender, private lending. My name is Clay Malcolm. I'm going to be your host for this particular presentation. As you can see, I've been in the self-directed IRA business since 2011, and I'm also an active self-directed IRA investor. And in fact, my IRAs have made a number of loans, so I have some experience in terms of what we're talking about today. If you do have questions after the presentation, something more specific or something that I didn't cover, go ahead and reach out to me. Give me a call on the phone, send an email. Happy to talk to you about whatever your scenario or strategy is. And all the information today is for education purposes only. At Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular type of investment or investment vendor. And we certainly encourage you to talk to your financial team anytime that you are thinking about an investment for your IRA, whether that is to help vet the investment or to just find out and investigate whether it's good for your particular account strategy. At Advanta IRA, we try to make the experience of having your self-directed IRA go out and invest in the world a personal one and one that is as convenient for you as it can be. So we actually assign each account holder their own account manager, so you have a person to go to no matter what your question is, whether you're wondering about a particular investment, timetables, things like that. You go directly to your account manager. If they don't have the answer, certainly they'll go through the rest of the building and find the answer. But you yourself as an account holder have a direct source for information about anything that has to do with your account. And your account, if it has uninvested cash, that cash is FDIC insured, it's in a bank. And in terms of our experience level, we've been around for almost 20 years. We have over $1.3 billion in assets under management. And again, we've seen these types of investments, and we are here to help you to execute the strategy that you want to execute, and also to make sure that the account is kept, the bookkeeping and the administration is such that it gets to keep the tax benefits that are associated with the account type. Our role is not to give you any advice or to tell you what to invest in or when to sell or any of those things. You provide that strategy. Our role is to make sure that the account is in good standing so you get to keep the tax benefits, and to make that process as easy as it possibly can be. So remember that when we're talking about the self-directed IRA investment process, what we're talking about is account types with specific tax advantages, and they are the account types are the ones that you know: traditional, Roth, SEP IRA, simple, solo 401k. Some people are not familiar with the fact that their health savings account can also invest in this way. But self-directed does not mean a particular account type. It actually is just a term that talks about and describes the fact that the account holder is going to be the decision maker in terms of the assets that that account purchases and sells. But the account types themselves, they stay the same. Same contribution rules you're familiar with, same distribution rules, and same tax advantage. So what you're doing really is marrying the account type and its particular account advantages with an investment strategy that you think will work for you. And when it comes to investing at Advanta IRA, we handle all kinds of alternative investments that you may or may not have been familiar with for your IRA or your tax advantaged account to invest in. There's real estate, both residential and commercial, private equity, precious metals, obviously that's gold, silver, platinum, and palladium, bullion products, oil and gas, agriculture, hedge funds, and today, of course, we're going to be talking about private lending as a specific account investment strategy. Now, taking a little bit broader view, there are a few rules that all IRA investing need to take into account because they come from the IRS, and of course the IRS is the entity that is granting the tax advantages. So first and foremost, there are a couple of asset classes that are prohibited for your investment, and that is life insurance and collectibles. Life insurance is relatively self-explanatory. Collectibles is anything like fine art, let's say a collector car, investment wine cellar, things like that. So those types of things are relatively hard to value, and so at some point in the rulemaking, the IRS just prohibited those collectibles from investment by IRAs. There are certain prohibited transactions, and typically what that means is that there is a set of persons who is disqualified or has some restrictions in terms of the way that they interact with the cash and assets in the IRA. So those disqualified persons have some restrictions in their behavior and their transactions that occur with the IRA. The text for this parameter is set in the Internal Revenue Code section 4975. So if you ever are looking for detailed information about that, you can go and look that up. And then UBIT, and that comes from both UBTI and UDFI, those are taxes, but they are not penalties, right? So for prohibited transactions, that's a disqualified person doing something that the IRS doesn't want you to be doing. UBIT, or unrelated business income tax, it is a function of certain types of investing in your IRA. And it's not a penalty. You didn't do anything wrong, but it is something to keep track of, because in order to submit that unrelated business income tax that your investment strategy has put into play, you have to file a Form 990T, file that with the IRS. And if you owe UBIT, unrelated business income tax, then your IRA pays the IRS that unrelated business income tax. And usually it comes in two forms. If your IRA has invested in a company that has business income and is not housed in a C Corp, then lots of times you may incur unrelated business income tax as a result of that business taxable income. And then also, if your IRA is investing in real estate and it borrows money, of course, today's webinar is about the IRA lending money, but your IRA can borrow money as well. The profits that you make on the debt finance portion can sometimes incur UBIT. So again, file a 990T, make sure that your IRA pays any UBIT that is due on that unrelated debt financed income. And for more information about that, just call us or check out our website. And I mentioned disqualified persons in terms of, a group of people that have some restrictions, so I'll just detail that real quickly. The disqualified persons for any account are the IRA holder and their spouse, ascendants and descendants, and the descendant spouses, as well as some fiduciaries. That typically happens more often in 401k plans than IRAs, but anybody who's fiduciary to the plan is also going to be considered a disqualified person. And it is these people and their personal finances, as well as any entity that they own or control. So if your mother has an LLC and is the owner of that LLC, then that LLC would also be considered a disqualified person or entity. And when it comes to transactions, there are a few things that the IRS says that set of disqualified persons can't do. So sell property, exchange property, personal use. Those folks can't personally use or take benefit of the IRA-owned assets, and they also can't furnish goods and services to those. And there's a reason behind all of it, but for today's practice, we're just going to say that those things are, that set of people can't do those activities or perform those activities with the IRA. And most germane to what we're talking about today, of course, is lending money or extending credit. Therefore, your IRA can be a private lender, of course, which we're going to detail here in a second, but it can't lend to that set of people and entities, so the disqualified persons and entities. So we talked about what you can't do. Let's talk about what you can do. An IRA actually has a lot of latitude in terms of its ability to make loans and what those loans look like. The IRA can be an originator, so the IRA holder finds a person that they think is going to be a good borrower, sets the terms, and generates the note. But if you don't want to be, your IRA doesn't want to be the originator, it can also buy existing notes, and that can be whole or fractional. So you could buy a discounted note, and if it's non-performing, you could renegotiate it, so on and so forth. Or you could just be one of several people buying out a very large note. Your IRA could be a fractional owner of a note on an office building, let's say, something like that. The IRS will let your lending be secured by collateral or not. So unsecured or secured loans, both of those are fine from an IRS perspective. You can be an equity participation, and that can come in a couple of different forms. One is your IRA could invest in a private entity that is then going to collect that money and make large loans or many loans. Or your IRA can actually make a loan where you not only receive interest, but also equity participation in whatever the loan was for. And we're going to talk about that in a real estate scenario here in a moment. But equity participation can be involved in these debt-based investments. And as I mentioned before, no loans to disqualified persons. But generally speaking, the IRS will let your IRA participate in any kind of loan as long as a couple of things. It has to be a real business transaction, so it can't be some sweetheart loan that you don't expect the person to ever pay back. That would be a gift, which is in almost all cases prohibited. And it also can't be a predatory loan. Of course, your IRA cannot participate in illegal activities. So the loan terms have to be somewhere within regular business practices. But that notwithstanding, the IRS does not weigh in on the interest rate or the terms or any of those kinds of things. So when you're thinking about establishing the note terms, and I'm just going to take a generic kind of origination scenario, you're thinking about, of course, what is the amount that's going to be borrowed? You're thinking about the interest rate. What is my expected return to my IRA for making this loan? Talk about the length of the term. So is it going to be 6-month bridge loan, or is it going to be a 30-year mortgage loan? All of those are fine. Equity participation, if there are any of those terms, that can be incorporated into the note as well. And payment due date and delivery address, and all of this is really about the notes management and function. So the repayments, in most cases, come back directly to the IRA, but you certainly can hire a loan servicing service that is involved in that type of activity for you as well. So you can do it as kind of a do-it-yourself, or you can have a loan servicer engaged to be working on looking at payments and making sure that they come in on time and things like that. You know, at Advanta IRA, you can always just check on your IRA's online portal to see if payments are made. So the do-it-yourself version is pretty easy with us. And certainly you would want to consider including, you know, provisions for late payments or anything that's off schedule. And of course, if you have collateral attached, making sure that that collateral is in a position where you as the lender, who is essentially would be foreclosing on that defaulted loan, can get a hold of that collateral. So some of the nice things about IRA private lending are you actually know the rate that you're going to be getting because it's written in the terms of the note. So there's, to some extent, a lot less mystery about what your returns will be. Some people like to make loans in a real estate world rather than invest in the real estate directly because they feel like that would be less liability for them. So that is certainly a strategy consideration that you might take into account. In a lot of cases, especially if the borrower is a good risk and paying back the loan on time every time, the maintenance on this type of asset can be very low, so almost completely passive. And as I mentioned before, your IRA does have the ability to participate in a lot of different setups of this. So it can partner with other funds in a couple of different ways to make sure that, or to allow the IRA to participate in, let's say it doesn't have the entire amount of a loan, but you want to participate in it. So that fractional participation can really be a nice way for your IRA to make money. So let's talk about some of the case studies that give you an example of what this looks like from a practical perspective. As I mentioned before, your IRA has a lot of latitude in terms of the way that it loans, but one of the more common ones is a mortgage type lending scenario. And in this scenario, we're going to say that Paul has 120 grand in his IRA, And he's just looking for a known commodity in terms of the return. So he's going to find a borrower. In this case, he goes to a mortgage broker to see if he can put him with a borrower. And he has a loan amount, 120 grand, sets the interest rate at 8% with a 5-year balloon payment, and the monthly payment for interest only is going to be $800. And this is going to be a secured note, and that means that should the borrower default, that Paul's IRA would be able to foreclose on that property. So how does Paul do this? He opens and funds an account with us, meaning opens the account and then he does transfer, rollover, or contribution, or some combination of those things to get funds into the account. In this case, he has $120,000. He finds the borrower. Again, in this case, he used a broker, but that's not necessarily, it's not required. So it's not necessarily the path that you would choose. When he finds the borrower, he makes the offer and presents the terms. And what he would do is really work with his account manager at Advanta to make sure that the paperwork that starts to get generated around that note matches his terms, and that it documents what his IRA is doing, so that he gets to keep the tax benefits. And any document that the IRA is going to describe the IRA's participation, Paul will obviously be the person who evaluates that and signs read and approved and things like that on that document. Now, of course, Advanta IRA is the signer for your IRA, and so the actual lender is Paul's IRA, and as the signer for that, Advanta IRA will sign that on the lender line on the note on behalf of the IRA. So what does Advanta do? Well, we review the documents again to make sure that it documents what's happening properly. We get Paul's approval, read and approved on the documents. For the closing, we would wire the $120,000 to the closing, and then the mortgage is recorded and the note. All of that is in the name of the IRA, not Paul's personal name. So making sure that all that documentation is taking place in the name of the IRA. And then the investment is complete and repayment would start. So after the close of escrow, the borrower would be sending his monthly interest-only payments to Advanta, where Paul can see it on his online portal. And that's the way he's going to do this. He's not going to hire a loan servicer. And 3 years later, the borrower decides that they're going to sell the house, and Paul is going to receive his principal back. And in this case, he's also received the interest payments along the way. So Paul's IRA is going to realize repayment of the original principal as well as the interest that was designated in the note, and all of that comes back into his IRA and is ready to be redeployed or reinvested without being taxed, right? That's the tax deferral that we were talking about at the beginning. So, and this obviously, again, it means that that money can compound faster. So the benefit of having made this loan in the IRA rather than his personal funds. Case study 2. Let's talk about a loan with equity participation. It's actually something I've done as well. So Andrea has $150,000 in her IRA, and she wants to participate in real estate, but she doesn't necessarily want to be the flipper herself. So she's going to find a person to loan that money to, who is going to do a flip or a rehab in this particular case. So she finds Steve. She found him at a local investor event, and that is a relatively common thing. So your local RIA or other meetup group may be a great way for you to put your money into play with the particular partner that you're looking for. So Steve agrees to use the loan money to do some part of the purchase and part of the rehab, and he's going to use the property as collateral. So Andrea agrees to loan him the funds that he needs to complete his project. And in this case, the loan amount is going to be $125,000, interest rate of 5%. But Andrea also would like to participate in the profit of this venture, and so she is going to be an equity participant of 1/3 of the profits. It's going to be a 2-year balloon note, and the monthly payment will be $520. And of course, she has a first mortgage on the property. Well, not of course, but that's the way that they set this up. Andrea's attorney prepares the note and the mortgage, and of course, because Andrea is the account holder, she will get all the documentation and read and approve that before we sign it on behalf of the IRA. And in case this wasn't clear before, Advanta, as the custodian of the IRA, also keeps the documentation. because it is the IRA that owns this note. And so all that documentation for the note as well as the collateral is held at Advanta IRA as well. And then when Steve is ready to sell the property, he'll request a payoff amount. Andrea is her own loan servicer, and she provides a payoff letter, which is sent to the title company to help with the closing. And in this particular case, we're saying that Steve sold the property for $200,000 net after closing costs. So good for Steve. And good for Andrea, because what's happened here is her principal has gotten repaid at $125,000. She received monthly payments of $3,000 over the course of the loan, and her percentage of the profits, 1/3, is $25,000. So her IRA has earned $28,000 over the period of the loan. And Steve did well too. So his original loan amount was $125,000. He sold the house for $200,000. And he's repaying the loan and profits and interest of $28,000, right? So that means that he ends up with $47,000. So good for him. And we've used really simple numbers here, and your loan can be relatively simple, but obviously just we pared down the numbers for education purposes. So if you think that this is a little oversimplified, it is, just to make it kind of understandable from a strategic standpoint. Now, both of those loans had real estate as the collateral, and I do want to just step in here and say that the collateral for the loan can be all kinds of things. It does not have to be real estate necessarily, although I think that that's probably the most popular. So if a loan could even be collateralized using a prohibited asset. Now, that's going to mean that so in the slide here, you see a stamp collection, right? So that may be a little problematic if you ever have to foreclose, because obviously the IRA can't keep that asset if the note is defaulted, and the IRA theoretically is supposed to take possession of the stamps. Then there needs to be a liquidation take place or some other type of arrangement so that the IRA does not end up owning a collectible, which is obviously prohibited. Now, if the collateral is a company or stock in a company or something like that, it's a good idea. Again, we talked about UBIT a little bit earlier, so it's to your advantage to find out what kind of tax status that company has and what kind of status that stock has. Is it easy to liquidate? Is it not easy to liquidate, et cetera, et cetera. And remember, of course, that S corporations can't have IRAs as shareholders. So again, that would cause a problem if that was the arrangement, that was the collateral, a share of an S corp, because an IRA can't be a shareholder in an S corp. So thinking about these things ahead of time when you're considering the collateral is obviously to your advantage. And understand what to use as a security agreement. I mentioned earlier that one of the things that you want to do from a lender standpoint is make sure that whatever collateral is pledged is in a place where you can get it. In other words, you have the ability to take possession of that asset that was pledged if there's default. So taking steps to make sure that that's all in line before you make a loan is obviously helpful for your strategy. And the last one we'll look at is unsecured lending. As I mentioned, the IRS will let you make loans that are unsecured as well. In this case, Tom has $50,000 in his SEP. He has a friend who wants to expand his business, and so he's agreed to loan him that money on a relatively short-term basis. And the promissory note is important here because there's no collateral, so making sure that the payment terms are understandable, and et cetera, et cetera. But the collateral itself, because there's none of that attached, this is one of those cases where we are very strict about having the original promissory note, because it is the only documentation of what's happening here in the account. So in this case, the loan amount is 50 grand. The interest rate is going to be 10% for a year, 1-year balloon note. So if everything goes well, the lump sum payment would be $55,000 coming back to the account. Because there's no title and company involved, as I mentioned, the original note is required by us. It's interesting in terms of the interest rates, because generally speaking, the more secure the loan is, the better bet that the borrower is, the lower the rate will be. So thinking about that in terms of what kind of interest rate are you looking for from this person, and is that something where you should maybe ask for a little bit more interest? because there is no collateral. That's obviously up to you. It's not up to the IRS. It's not up to Advanta, but it is one of those things that in the marketplace tends to have some, some pull. So do think about that in terms of when you're creating the agreement. And obviously vetting the borrower is going to be part of your due diligence for any of these notes or any investment that you're going to be making in your IRA at all. So we talked about the wide variety of notes that an IRA can invest in, that the process is relatively simple, and I'll just reiterate that. So all you really need to do is open an account, make sure that you have it at Advanta so that your IRA can make these types of, invest in this type of asset. And it only takes about 15 minutes. It's very easy to do. And you'll get an account manager, as I mentioned, to help you with anything that has to do with your accounts activities. You fund that account with transfer, rollover, or contribution, or some combination of those things. And then you go out and you start investing. So finding that borrower and starting to create the terms for the promissory note. And again, it's one of those investment strategies that the IRS doesn't weigh in a lot on. So you have a lot of creativity in terms of how you can arrange that for the benefit of your IRA. Again, here's my contact information. If you have any questions or want to talk about a loan strategy or scenario, please feel free to reach out to me. I'm happy to talk to you about any of that type of thing. And I appreciate your attendance today. Hopefully this was helpful, and let us know if we can be of service. Happy investing.